Good morning, everyone. Thanks for coming along to listen today. We were going to title this presentation, Ignore Banks at Your Peril. A little bit controversial because it's a very unloved sector. But I'm going to split it into three parts. So the first part is talk a little bit about banks, what's happened over the last 10 years since the financial crisis. Then talk a little bit about FinTech. It's obviously very topical. It's very interesting at the moment, what's going on and how that affects the sector. And finally, we'll talk about one of our funds, Polar Global Financial Trust, which we launched 6 years ago as a way of obviously playing the sector. And obviously, hopefully have 10 or 15 minutes for questions after that. So my name is Brind. I work at Polar Capital with 6 colleagues. My co-manager, I'll touch on him later, he manages the trust with us. And we've been looking at financials for too long. So I had hair pre-2007, so that shows you, we all lost money during that, and I lost my hair as well. But anyway, I'll go through this and talk. So hopefully it'll be interesting. So where are we today? So if you bought a portfolio of bank shares at the lows in March 2009, you would have made close to 3 times your money. Now, despite that, you would have done better buying, a global fund of equities. So even though financials actually have performed very well since then, banks have really lagged. Not surprising, perhaps, what happened, but actually a lot of that lag has happened in the last 18 months, and that's why we think there's a really interesting opportunity today. So if we go back to, obviously, the causes of the crisis and what's changed today to sort of understand why we think the sector has changed materially since then. So firstly, it's obviously about, key to investing in banks or insurance, which I can touch on afterwards for those that are interested. It's all about balance sheets. You've got to remember that banks are putting risks on their balance sheet, obviously loans in this case, and you want to understand how they're going to perform, obviously in a stressed scenario, recession. Obviously, part of the problems 10, 12 years ago was banks were insufficiently capitalized. Today, you're looking at banks holding 2, 3, 5 times as much capital as they did back then. In the case of the US, you have to go back to the sort of 1930s to a time when banks had more capital than they did today. So for us, the first step when you're looking at the sector is actually, have they got sufficient capital? We think so, very much so. Even in Europe, we don't have the data going back that far, but maybe, to the 1990s. Yes, there's an individual bank that probably could do with a little bit more capital. We can think closer to home, Co-op Bank and Metro, they've had difficulties. But, predominantly, the sector's, much better capitalized than it was. Banks' appetite for risk. So, okay, they've got plenty of capital, but going back to before 2007, it's all about who you're lending that money to. So if you had a pulse, you could get money off the bank. Self-certified loans, or ninja loans, as some of them are called, no income, no jobs, no assets. Liar loans, as they're called, 100% loan plus loan-to-value mortgages. So Northern Rock being a classic there, where they had this 125% loan-to-value mortgage. Which just, then it was ludicrous, and it's obviously even more ludicrous, looking back on it. Now, the difference today is banks are much less willing to obviously extend risk. They're obviously being a bit more prudent. Regulation has come in, obviously here, mortgage market, buy-to-let regulation. But it's not just in the UK, it's globally. Leverage loans is another area where perhaps there has been some concern. So going back to 2007, banks had close to $450 billion of leveraged loans on their balance sheet. This is loans to the non-financial corporate sector, highly leveraged companies. Today, it's less than 80 billion. And a lot more of that risk has been pushed off banks' balance sheets to capital markets. So we believe, obviously we'll have to wait and see what happens in the next downturn, that when the next recession hits, more of that risk will be felt in the high yield market. Now, the hint that that's probably the case is in 2015, 2016, when the oil price fell, it was the high yield market that got hit, not the banking sector. Now, at the end of the day, banks are still, they're cyclical businesses, there's indirect exposure there. So that hopefully gives you a little bit of favour. And this is sort of highlighting this chart on the left here, what we call non-performing loans. And you can see it's just a ski slope downwards with that little blip when there was a bit of trouble in the energy sector. There's no, at the moment, there's no asset quality issues in the banking sector. Complicated chart on the right, but basically it says loan losses in a downturn are correlated with loan growth. So the more banks lend, obviously the more they loosen their lending standards, the more they lose money. And at the top right there, you can see 2008 or 9. The orange diamond at the bottom is where we are today. So it's actually saying that there's actually much less risk in the system. And if you believe this chart, banks will see almost no pickup in loan losses in the next recession. Probably unlikely. You're going to see individuals lose their jobs and default, companies default, but it will put banks in a much stronger position. Liquidity, I'm putting myself out to be laughed at here, no more Northern Rocks. I suppose what I'm trying to say is Northern Rock ran out of money within 3 or 4 weeks. It was so reliant on wholesale funding. It had what they call a loan-to-deposit ratio of 300%. So for every deposit, it was having to be lent out 3 times. It had to go and find that money from wholesale borrowers. Today, banks are much less reliant on wholesale funding. It's more sticky deposit funding. And it's much shorter where they do have some wholesale funding. So perhaps the surprise post-crisis, when you think of the difficulties that Co-op Bank and perhaps more recently Metro, is actually how resilient their funding has been. And this comes back to, we like banks that have got deposits. And that means they're something that's perhaps not valued as much in the market today, where interest rates are 4 and 6 pence or minus 50 basis points, 40 basis points, whatever it is in the ECB. But at some point in a downturn, that funding is key. We've seen this through cycles. During the Asian crisis back in the late 90s, HSBC had huge inflows from deposits from obviously local Asian banks, because everyone knows they would be there, whatever happened. FinTech. RBS had this sort of quote, their busiest bank branch is the 701 train from Reading to London Paddington. And it really just highlights just how markedly banking is changing. So, this, you can do everything on this now, obviously. You can deposit your check on it, for those who haven't tried, if you still get checks. Waiting for great aunt Agatha to send some for her £10 at Christmas. But it's that ability. So fewer and fewer people are using their branches. There is obviously an issue there. There's still a need for small businesses reliant on cash. And so as a result, you're seeing bank branches reduced. And obviously that gives the ability for banks to cut their costs. So we'll touch on some of this, obviously challenges coming through and obviously how the incumbents are reacting. One thing I did want to touch on really is that we're in an Alice in Wonderland environment, I think, now for markets. Obviously what's going on in interest rates, but also valuations. Now here too, I mean, there's so many of these startup banks that are around at the moment. But here too are the most well-known, Monzo and Revolut. I use Revolut, go on holiday, your FX is effectively almost free, unlike if you use your normal bank with HSBC, Lloyds, etc. Monzo is obviously very, very popular. It's got 3 million customers. Again, similar. The functionality on here, budgeting, etc., able to split bills, it's very, very popular. What I'd highlight here is the valuation that private markets have put on some of these businesses. So, around £2 billion. You can see the revenues these businesses have produced is pretty small, and obviously, losses have built up. But in reality, what you've got to think is both of the backers of these businesses have probably put in no more than a couple of $100 million, and yet they've created 10, 15, 20 times the value by doing that. And we'll come on to in a minute, the amount of money that the incumbents are spending, it's an extraordinary value creation. Now, obviously a bit skeptical. The one difference with banks between a lot of other tech startups is you don't have the network benefits that some of those, the Ubers, the Facebook and so forth have. We don't all need to be using the same bank. And also, people get divorced more often than change their bank account. So I've changed my, sorry, actually I haven't changed my bank account yet. Careful what I say there, I've just got married. So it's very hard for these businesses to attract new customers. And in the sense, the giveaway is by doing it for effectively, for building up these losses, for FX in this case, in the case of Revolut. But I thought it was interesting if we compare it with two current mid-cap UK banks out there. Not quite apples and pears, but these are two, Close Brothers has been around, I'm trying to remember, it's the 70s or 80s it was launched. It does a lot in asset finance, motor finance, small business lending, premium finance. One Savings is the old Kent Reliance Building Society, very focused on buy-to-let, but both valued pretty much the same as Monzo and Revolut. And the numbers speak for themselves. 3 years of profits, 500-600 million, and you compare it to what we had before. So there's definitely a disconnect here. We think we own One Savings. Close Brothers is a great business. We'd happily own it. We can't own everything, but there's a huge disconnect in valuation between these two. And the interesting thing is what happens when some of these businesses then list on the market. And for all its faults, public markets are a much more skeptical bunch. Turn to this, the good and bad and the ugly. Be careful what I say here. But obviously these are peer-to-peer businesses. For those who don't know, it's obviously you as an individual, an institution puts money on their platform, they lend it out. They're not taking any balance sheet risk. Now, in the case of both of the two on the left, they're perfectly good businesses. Funding Circle focused on small business lending, something the banks obviously don't do well. So again, there's no reason why any of these businesses don't continue to grow. Monzo and Revolut earlier, but it's a question of what's the right price for that that potential growth. And the issue with these businesses is going back to what happened to Northern Rock. They're both very reliant on the kindness of strangers. Wholesale funding. They don't have that solid deposit franchise that the big banks have. So if something changes, as it did with Lending Club, with a fraud allegation against their chief executive, suddenly that funding gets turned off and they can't, obviously roll over new loans. They can't originate new loans at the same speed. In the case of Funding Circle, obviously, they've seen some deterioration in asset quality, so they've tightened up their underwriting criteria. And again, they're models driven by generating money off new borrowers, where they generate most of their fees. And on the right here, in a sense, when we come to FinTech, China is perhaps, the biggest market for FinTech. And is perhaps the most fascinating. Obviously, you have Alibaba there, Alipay, and so forth. But here in China, you've had over, 4,000 peer-to-peer platforms have failed. And you've seen a number of banks actually recently. So it's highlighting, be a bit skeptical about some of these startup businesses, businesses out there. On the left, that's just obviously highlighting, Funding Circle. You can see the deterioration in where projected bad debts have continued to rise, despite actually the economy being, all things careful what I say on politics, being relatively resilient in the UK. Peak regulation for banks. So obviously one of the headwinds for the sector has also been regulation. There's some fantastic quotes out there about the length of some of these regulations being longer than War and Peace or the Bible and so forth. But quite rightly, the sector needed more regulation post-crisis. But you've had an enormous increase relative to any other sector. And I suppose the question is going forward, if you take a 10-year view, which sectors are going to get hit more? And arguably, obviously, certain Elizabeth Warren has made quotes in the US about what she intends to do. Technology, talking about antitrust. Obviously, investigations going on with the DOJ and so forth. So, I think it is changing. What you've seen in the US is actually a reduction in some of the regulations. We complain over here sometimes about regulation. Unintended consequences, etc. All good intentions, but there's unintended ones. In the US, they have a multitude of regulators. I mean, here it's the PRA and the FCA, pretty much. Over there, it's 6, 7, 8, 9 regulators. You could be regulated by your state. You could be regulated by the Fed. There's a multitude, which causes an incredible amount of distraction for management. Love them or loathe them, but obviously the Trump administration has rolled back a lot of regulations at the margins, and that's just not to say that they are. It's more to say you've gone from an environment where regulators were perhaps combative to one that's more a constructive relationship between banks and the regulators. Again, there's a difference here between Main Street and Wall Street. So again, politicians have been very positive about helping small community banks. So a lot of the regulations have been lifted off those. But anyway, that hopefully gives you a feel there. Who is Erica? Again, coming back to how the banks are reacting, you all probably heard of Alexa, Amazon's Echo device. So Erica is something Bank of America has come out with. And so in a sense, you just pick up your phone and you speak into it and say, Erica, please transfer $200 to my account, to my daughter's account, my wife's checking account. And it's done automatically, straight through pressing. You don't have to log in and tap in or whatever like that. Early days, but all this is things that the banks are doing to react. The 3 banks in the US, the largest 3, each spend over $10 billion on technology a year. Upwards of $3 billion of that is allegedly on R&D. It's almost impossible for some of these startups to compete. What you've also found is, again, going back to the issue about how do that cost of customer acquisition. For a VC, you actually want to partner with a bank. As soon as you partner with a bank and you've got access to 2, 3, 4, 5 million customers, you immediately de-risk the opportunity. Okay, you're not going to make a 10 or 20 times your money, but you've certainly got more chance of making 3 or 4 times. So you've seen a lot of that go on. Certainly they're having to up their game, which is a good thing. We touched on obviously smaller branches. Here you go to Scandinavia. We use DNB as an example, Norway's largest bank. 80% or thereabouts branch reduction since in the last 10 years. I believe you go to Stockholm today, it's impossible to find anywhere that accepts cash. So again, it highlights on the right. It's so much cheaper. The more we use our phone, then obviously its ability for banks to cut costs. And what you found, this squiggly orange line here, is what's the cost per assets. So it's showing the efficiency with which, in this case, DNB has been able to obviously bring, in what has been a more difficult operating environment with their interest rates coming down. So the Scandinavians, great examples. They're doing very well, and you continue to see really good profitability. Obviously, it's slightly at odds with some other banks. What else is worth touching on? I suppose the difference today to 2007 is that we're obviously in a much lower growth environment globally, or particularly in developed markets. So in a low growth environment, banks aren't growing their balance sheet as much. And that means banks obviously don't need to retain as much profits to underwrite new loans. So it's being returned to shareholders through buybacks and dividends. So in the US, that's it's upwards of 10%, 11% capital return. And it's enormous. Now, obviously, it's predominantly buybacks, and the advantage of buybacks for a sector that's incredibly undervalued and unloved is it's very accretive to earnings. So just on the buybacks, it's adding 6-7% to banks' earnings each year, all other things being considered. In Europe, elsewhere, obviously the alternative is most of that's coming through dividends, so you're getting like 5, 6, 7% dividend yields. Which again we think is incredibly attractive. One of the things that comes back to us in meetings is, well, obviously debt's gone up globally, so why would I want to own banks? And I thought it was worth just highlighting this. The consumer in the US is much more resilient today, and even over here, a function obviously leverage has come down. Obviously the affordability ratios from borrowings because of interest rates coming down. And savings ratios have picked up. So actually the US consumer is in a pretty good shape. We're told, someone was highlighting the other day to us, Obama obviously, you could say was elected for the 99%, but as a function of QE, et cetera, the 1% did a lot better, and Trump was, voted in for the 1%, but the 99% are actually doing better. You're seeing quite a big uptick in wage growth in the US. One very entertaining story I heard. So to highlight, obviously the tightness of the labour market over there is, there's a Midlands, one of the fastest growing cities in Texas, obviously the shale boom. And this company is looking to put a premise around their offices, and they couldn't find anyone who could do it because there's just a complete lack of availability. So they went for an hour outside Midland, got this firm to come in. They put their tools down, the head foreman went off to a local branch or whatever it was, get some more equipment, came back, all his staff had gone. And they'd been poached in the previous hour and a half by an oil company who'd just driven past. The guy said, what are you earning? I'll double it if you sign on now. So that just sort of highlights in some places, which we're actually why we're remaining pretty positive. Key to highlight is obviously for banks, you remember they make how do they make their money? It's a margin between what they lend out to borrowers, mortgages, loans, and what they receive on loans and what they pay out on deposits. This complicated chart on the left is saying banks are just highly correlated to interest rates and bond yields. So here you saw the election of obviously the Trump administration, higher interest rates, banks outperformed, and we've had the opposite. So this is why today is actually really interesting. The last couple of months is you've had interest rates expectations, bond yields have fallen significantly over the last 12, 18 months, and the sector's massively sold down. We've only just started to see a bit of a jump now. So we've started to see value outperform growth, and we'll touch on that. So that's key. If you believe, in 10 years' time, we won't be in this sort of Alice in Wonderland environment, and interest rates do go back to some sort of normal level, then the bank sector is fantastically positioned for that. Any interest rates going up would be great for the sector. So you think, obviously, some of the narrative today about fiscal spending. Everybody's thrown out their sort of willing to suddenly start spending money, obviously here in the UK, and all that is obviously helpful. The more governments decide to spend, then that takes the heavy lifting off monetary policy. And this is sort of going further. So this is why we like the sector at the moment. For a sector that probably trades on a 20-25% discount to the market, has sold off to 40 in the case of US banks, European banks probably 50, 55%, Japanese banks similar. You've seen a huge derating of the sector. So the sector is already pricing in a downturn in the next sort of 6-12 months. And we think that's why we think there's that opportunity, because if the economic data starts to pick up from here, which some of the leading indicators say that we're starting to bottom out, then the sector is fantastically cheap. Obviously, if we do see continued deterioration, then it's already pricing in some of that downturn. We think it's probably pricing in like a 2001 recession, so more of a corporate downturn. Value growth, you're probably obviously seen this in papers, this whole argument, tech has been the place to be the last 10 years, and anything with a sort of value bent has seen a huge derating, going back to almost sort of TMT, tech bubble times. Again, we've started to see a little bit of a change in the last few weeks, and value actually start to outperform. And the thing is, people are so underweight the sector that once it starts to move, you can see some quite substantial moves in the sector as people try and reweight portfolios. Value indices, again, banks is the most one of the cheapest sectors out there. They're the biggest sector in the market. So people do ignore them, at their peril, because if that sentiment changes, then institutions, very quickly have to reweight how they're positioned. So again, we think it's you're not being you're being paid for while you wait with where valuations are at the moment, and you've got this almost free option. I thought this was quite entertaining, sort of tongue-in-cheek. There's a young guy who started investing when he was 16. I think he's about 79 or 82, I can't remember. Warren Buffett is on public record saying he struggled to find value. And almost the only thing he's bought this year is US financials, or really just US banks. So he's put $16 billion into it. He's taken his investment portfolio from, I think, 32 to 47% is invested in US financials. there's one small airline purchase. But again, that highlights his track record, obviously, on things like IBM and more recently Heinz. Not perfect, but he's been pretty good at picking his US banks. And I put here a quote from Galbraith about forecasting the future. So this is to do with economic forecasting. There's those who I know I don't know. There's those who don't know, and those who don't know they don't know. So what if interest rates or bond yields do go up? No one buys into it at the moment. So that's very quickly. In the last a few minutes, I'll just touch on just the trust, and then we can open up for Q&A. So we launched this Polar Global Financial Trust 6 years ago. It really is a low-risk way for investors to play the recovery in financials. Dividend yield around 3%. Over that time, we've grown that dividend by about 7.5% per annum. The NAV has grown by around 9.5% per annum, despite the sector being out of favor. It's providing very much a global play on the sector, income and growth, and predominantly banks, not entirely banks. There's a lot of other interesting stocks out there. We own exposure to payments, think of MasterCard, PayPal, exposure to some really fast-growing Asian companies like AIA in Asia, HDFC Bank in India. But it is it's very much that value proposition, playing the sector. And how have we done? And I think this is where it gets really interesting. It's coming back to not looking at the sector through the prism of UK banks. So we've delivered sort of over 80%. And this is the UK peer group, which, even HSBC aside, has been a pretty sorry bunch. Now, obviously, some of that's PPI and things. And that's the opportunity. It's a global opportunity. There's fantastic businesses out there which are delivering good returns to shareholders. Just because Lloyds, Barclays, and so forth have struggled doesn't mean it's not actually a good place to, we think, allocate money. And then finally on the portfolio, you can see our largest holdings on the right. So very much it's dominated by US at the moment. We have started shifting more into emerging markets. Long term, you think of the growth in financial services, mortgages, etc. we saw in the 80s and the 90s. A lot of Asian markets are just at the start of that. Financial penetration as a percentage of GDP is very low in some of these countries. But it's there. It's buying what we think are really good quality banks and insurers that pay attractive yields, and around that some really interesting growth opportunities to hopefully give has and continue to deliver decent returns to investors. And then just the summary. So I hope that's been useful. Very happy to take questions.
Could you say a little bit more about insurances, please?
Insurance sector is one that we've liked. I mean, we split it into non-life. Think of the sort of direct lines, the Hiscoxes versus obviously the life companies, Aviva, Legal & General, and so forth. We like non-life. It's a very defensive sector. It's counter-cyclical. It's all to do with Mother Nature. So you've got a great sort of, that lack of economic sensitivity means it's an area that we, certainly during the Eurozone crisis, we had a lot more exposure. But the reason we like banks more than insurance at the moment is just the valuations are very cheap. Insurance stocks, as a generalization, perhaps less so one or two of the UK ones, have re-rated back to sort of historical levels post-crisis. Banks is one of those sectors that's still unloved.
Given how badly the UK banks have underperformed, and given that PPI, the long national nightmare, is now over, would there be an argument for saying that they should actually play a catch-up, at least to the undervalued non-UK banks, and maybe even, if your thesis is correct, substantially more?
Yes, I think that's very fair. I think there's one savings bank which we own, I think, is on 6.5 times earnings. I think Lloyds, I can't remember, 7.5 or 8. It sort of bounces around at the moment, but they are incredibly cheap. And so there's obviously a Brexit discount on there, the uncertainty, and when that's resolved, I think a lot of non-UK institutions will start looking at the UK again, and that's an area they'll look to. So we do hear that from people who say they won't invest in the UK currently, so that will change.
Looking at the risk, what would you say is the biggest threat to the banks?
I think the biggest threat to the banks is I suppose, a recession, obviously. Now, I think a lot of that risk is priced in for the reasons, hopefully, that were explained earlier. But naturally, that's going to hit. When you go into recession, some people go, "Oh, I don't need to own the banks." So you might see some. I think the equity market as a whole would fall in that case, and I think the relative performance. I'm trying to think if we got it in here. Oh, here we go. So this chart here, 12 recessions since 1937 in the US. In 8 of the 12, banks underperformed in the year preceding the recession, and 8 of the 12, they outperformed in the year the recession hit. So, surprise, surprise, the stock market's a discounting mechanism. So the evidence is that once you start going to a downturn, the sector starts to outperform. Central banks cut rates, obviously, fiscal stabilizes. But there's always a tail risk. I think the other one, again, which is less of an issue than it was 5 or 6 years ago, is obviously Eurozone crisis or concerns about the Eurozone again. Again, that would hit the whole market, but there'd be some European banks that would be hit very hard. So that's probably the most.
Could you summarise your principal reasons for investing in the unquoted Atom Bank?
Yes.
And is there a limit to how much of the trust would be invested in unquoted investments?
So it's 10%. That's the only. We've looked at quite a few. The thing we've struggled with is valuations. So we were one of the early backers of Atom in the first couple of raises, and we haven't followed it since because we just felt there's better risk reward in listed stocks. So we have a little exposure to something called Augmentum FinTech as another way of playing it. We think they're good managers, a bit more sensible on the kind of businesses, FinTech companies they'll back. But that's, so for the moment, we're not looking to add to our exposure.
Augmentum is quoted as well.
Augmentum FinTech's quoted. There's another one, Mello and Chrysalis out there again quoted, but Augmentum's pure FinTech. So do look at that.
What's your exposure to FX? Do you hedge it at all?
Yes, great question. It's about 85% is non-sterling. We've never hedged. So that has been a small tailwind for the trust since it launched, because obviously sterling's weaker, and it would be a bit of a small headwind going forward if there's obviously some resolution to Brexit. So be aware of that.
Hi Nick, I wanted to ask with regards to Deutsche Bank and whether or not there'd be any potential impact going forward regarding the litigation and the toxic debt they've got on their balance sheet for the whole industry.
Yes, obviously we've never owned it. We wouldn't. It's the interconnectedness of the financial system. Now, the difference today to the middle of the Eurozone crisis is if you looked at, say, just take BNP, France's one of its largest banks, and you looked at its securities portfolio, and it would have owned obviously French bonds, Italian bonds, German bonds, Greek bonds, Portuguese, Irish. Today, when you look at most banks, they've withdrawn to their home sovereign market for their liquidity portfolios. So some of that interlinkage is much reduced, but there's counterparty risk there. Oddly, I think it's probably the best thing that could ever happen, because the Germans like to wear their hair shirt about following the rules. And actually, if Deutsche got into particular difficulty, it forced them to actually act. And there's issues. The problem with Germany is it's an overbanked market. You've got the state guarantees of the Landesbanken and the savings banks. And the simple analogy we use is banks in Germany and China are sort of, Japan to some extent, are there to lend to industry. Whereas banks, in the US, UK, etc., are there to make money by lending to individuals or industry. And it's just a slight nuance which highlights why you don't really want to own a German bank. So there's risks, and they pop up every 12 months. But Deutsche's got a lot of liquidity, do a bit more capital, but it's sort of like a death by 1,000 cuts. So keep away. Yes, unless you're a day trader.
Hi, yeah. So I run a small mobile payments business.
Yeah.
And I'm sort of in the FinTech sector, and it's become so commoditized that I can launch my own banking solution within 12 weeks off someone else's rails. So my question is, I'm wondering whether the financial services companies of the future are more your Apples, Googles, Amazons than historically what we've come to know as being financial services businesses.
Yeah, no, that's a great question. I mean, to date, we've always felt that the big tech, because it is a fear, don't want to become regulated like a bank. And that's, from the point of view, you think of Apple Pay, great, they can take a tiny slither of fee income for the interchange fee. So you've got that, and obviously got this credit card they're doing with Goldman Sachs. Obviously, Goldman Sachs is going to take the credit risk predominantly. As soon as you go down that route of owning a bank, then hell's gates open. It's the last thing you want to do. Now, to the extent they can perhaps do, I think that if we're here in, if we're here in 20 years' time, maybe the likes of similar Monzos or whatever are around. They're like the front engine. But when you've got Lloyd's balance sheet is 800 or 900 billion, it's sitting there. The efficiencies it can achieve from scale, from leverage, incredibly hard. Tesco have thrown in the towel, Sainsbury's are throwing in the towel outside, unsecured consumers. So it's always a risk, but we think it unlikely. Yeah.
To what extent is Italy a nuclear bomb in terms of the banking system, not just for Italy, but Europe and beyond? Just coming back to a comment or two you made earlier.
Yeah. It's there. I mean, you saw what happened in Greece and Cyprus, I suppose. Cyprus, in both cases, they had to put in capital controls. Greece stepped back from the precipice because, they almost were too late because they created a banking crisis. The day you decide to leave the euro is the day you decide to collapse your banking sector, quite quickly. Now, Italy's in a much stronger position because there's got a lot of liquid. There's a high savings culture, obviously, or savings, in the banking system. They're less reliant on, the kindness of strangers, to go back to that phrase. But the fear of that happening, you've had it a couple of times in the last 3 or 4 years. The sector sells off quite aggressively, and you could argue it's a mistake to go into the euro, but where do you go from here? So I think it's pretty unlikely, but it's always going to be a risk. But it is significant tail risk, and it would drag down the whole sector. Yeah, definitely. I mean, we have no exposure to Italy in the trust in this fund, but you've got to be aware of that.
Nick, thanks very much
Thank you very
indeed.
much. Great, thank you.